responding to a trend in the mass affluent community that is a desire for more sophisticated portfolios than, you'd refer to as kind of the traditional 60-40 portfolio that I think it was 2021 experienced negative returns in both public equities and public fixed income. So folks are looking for more.
Kipp, thanks for coming back on.
Thanks, Ted. Good to see you.
I'd love to get an update on the breadth of Ares today. I know it hasn't been too long since you were on, but when you're growing fast, it's hard to keep up.
Firm does continue to grow. We're about $500 billion of AUM today, still dominated by the credit business, but we're focused on growth in a lot of the other areas. So real assets, which for us is real estate, infrastructure, and increasingly with an acquisition that we just closed called GCP, we're focused on sort of digital infrastructure and other parts of that asset class. With GCP, we're really a global firm now, right? This GCP acquisition brought hundreds of people in the Japanese real estate business, gets us entry into that market. So we feel like we've really kind of crossed over from being a US-centric firm into being really active in the US, in Europe, and in Asia.
So we're going to dive in on the private wealth channel in particular. And I'd love to hear kind of your capital formation trajectory in that space from when it started to where you are today.
We probably started focusing on 6 or 7 years ago, and we tried to figure out how to attack it, and frankly did a couple of things early, some good, some not so good. But it was obvious to us that that market was very large, that there was a tremendous amount of demand from that market to the alternative asset classes that we manage. But the short story, to accelerate, the way that we really started building wealth was actually through an acquisition. So we bought a company, I'll lose track of the exact time, but kind of during that COVID period, called Black Creek, that was based out in Denver. But with, in our head, what was really a real estate acquisition to kind of bulk up on the industrial side and kind of add talent investing. We inherited, obviously, a 75-person retail and wholesaling team. We were fortunate because the now head of our wealth management business was a pretty experienced Morgan Stanley guy. His name's Raj Danda, who had actually left Morgan Stanley a couple years prior to go out and be the CEO of Black Creek. So we had somebody pretty sophisticated there who understood wealth. He had been a banker by background, but had ended up in the wealth business at Morgan Stanley. And that was sort of the allure of Black Creek, and had been continuing to kind of upgrade the talent in what was a 75-person US wholesaler, retailer, selling both through wires, but also through the RIAs and the independent, folks. We accelerated the growth quickly, although I would say nervously at his insistence, which was the right thing to do. But he basically said, this whole opportunity is growing and it's becoming global. And we need to make sure that we kind of race to the finish line, because his view, and I think he was right, and we see it today, was that there would be 4 or 5 alternatives firms that really kind of were at the top of the market in terms of market share. And to put it in perspective, the early mover in that space was Blackstone by a long shot. And the reason they were is because they could afford to be. So they went out and hired a ton of people. It's a very people-intensive business. Raj basically said, we need to go from 75 to 150 people globally like yesterday, which we did, although took a little bit of a breath before we did it.
So what was that moment, that decision process where you hire them for their investment capability and all of a sudden you're getting pitched, hey, this is going to be a bigger opportunity?
When we were in the midst of negotiating the acquisition, we saw it as sort of an asset that we could unlock. But it was a really interesting period of time in 2000, 2001, whenever it was. Blackstone, because of their early lead in the market, had a roughly 60-65% market share in that channel. And 5-6 years ago, that channel was exclusively non-traded REITs and BDCs. That's what retail meant. So obviously Blackstone has 2 very large funds in that channel, and we're sort of an overwhelming market leader. almost to their disadvantage, right? So they'd gotten to a point where FAs everywhere were saying, this is great, my clients want more access to this product, but do I really want to be 60% exposed to Blackstone? Not really. I wish I could diversify. So the race to the finish line comment was a belief, and it kind of has proven to be true, that if we got there and we really focused on it by putting people in the field, educating the RIAs and the FAs about Ares and our products and all of that stuff, we could jump right up the leaderboard and get our fair share, which is sort of what's happened. There are now 4 or 5 firms that have probably, including Blackstone and Ares, that have probably 30 or 40% market share at the top of the stack.
What does your team that's doing that distribution look like today from the 75 to the 150?
Yeah, it's diverse. So, I mean, it requires a lot of servicing, right? Because it's smaller checks with bigger numbers of investors than we've been used to. So, I mean, at the top of the house, we have, kind of Raj, and he's got a handful of folks that I would call his senior management team. But below them, it's really a sales force in the field. And we have a bunch of both external and internal wholesalers. Internal wholesalers really means client-facing stuff. When there are requests that come in, they respond, obviously, to the huge number of clients there. The only other thing I'd add is that we did go out and actually hire a pretty substantial person in each of the European market in London and in Hong Kong. So we've taken the effort global as well, which is important. And actually last year, the capital raising that we did in Europe was tremendous and actually a little bit of a surprise for us. And I think this year may be that year for Asia. But being global is important because I think it's a global opportunity.
As you frame out what that team needs to look like, have you figured out the math of for every X number of clients or dollars, you need a certain number of people?
For sure, both on the institutional side and on the retail side, we spend a lot of time looking at metrics. I mean, it's really the 2 metrics that we like to use. They like to use our number of engagements divided by salespeople, right? So how many clients are you, how productive are you just on a visit standpoint? And then, of course, it's dollars raised divided by people in the field. And are you getting efficiency? And, it's all about making sure that you have the right message, you're going to the right people with the right things, because the death of a sales force is that you're deploying your sales force with clients in regards to products they're not interested in, right? That's just, you're missing, obviously, your effectiveness ratio is down. So
what do those rough numbers look like in the wealth channel?
The way that we think about it is just different from the institutional business. Generally, what you're seeing in these clients is they're putting $200,000 to $500,000 check sizes to work. And we've found that money is quite sticky. It's sort of a set it and forget it, particularly on the income strategies like REITs and BDCs. But a lot of the other strategies that folks are bringing are playing into kind of the 3 themes that we like to communicate around our products. One is durable income. So you have people that just say, here's $300,000 and set it and forget it. And I like the fact that it isn't particularly correlated with public markets and I get great income and I'm just going to let it sit there. And we find that to be very sticky. The second one is just diversified private equity. A lot of folks have done that through a secondaries platform. Others have done it through more of a primary private equity product. I know Blackstone does that, Vista does that. And the third is kind of tax-advantaged real assets. And we obviously, and others do that largely through REITs and increasingly through infrastructure funds.
As you look at those strategies, what is different, other than taxes, obviously, that you've seen from the demand in the wealth channel compared to what you see in the institutional channel?
I don't think there's actually a whole lot that's different. I think the driver at retail, and we have a particular lens on this because of our large public BDC, right, that has a stock price that tends to look and feel a little bit more like a public equity exposure to an RIA. And I had this debate for years with financial advisors where I'd say, just buy the BDC. And they're like, well, my clients don't like it when the stock goes up and down and they don't like the correlation to the market and the volatility. And so do what we do, like when stock goes down, buy more, and the stock goes up. If you want to, you can lighten up and sell it. And just after having had this debate, they love kind of the semi-liquid product that has very little correlation and not a lot of volatility, hopefully, if you're managing it well. And it just looks and feels, as they think about allocations for clients, very different than the traditional portfolios that most retail mass affluent investors are used to, which is stocks and bonds.
As you look out now over the next couple of years, how do you scope out what you think this opportunity is in the space?
Yeah, I mean, it's funny. A lot of different people are looking at it and come up with vastly different numbers. I think the point is, for us, it is a very large and growing market. And, importantly for us, it's just been historically for Ares untapped, right? So if you look at our roughly 500 billion of AUM today, about 40 billion, 40 of that is from the wealth channel. Most firms like Ares expect that 40% of their capital raising going forward will come from the wealth channel. I told them I thought that was high. That's not our expectation. But I think if we think about sizing new capital on an annual basis, my guess is something like 20% of our forecast for 2025 would be retail flows from the wealth channel.
Where's that inflection coming from? So you go back a few years, you weren't even thinking about it. Why is it happening now?
I think we're responding to a trend in the mass affluent community that is a desire for more sophisticated portfolios than, you'd refer to as kind of the traditional 60-40 portfolio that I think it was 2021 experienced negative returns in both public equities and public fixed income. So folks are looking for more, and they realize there are other things out there that they can do. But look, it's the increased preponderance of kind of private market transactions, the increased prominence of alternatives firms. I think there are a lot of folks that are sitting around with whatever their, investable assets are, $3 to $10 million, and they're saying, all I read about is, KKR and Apollo and Ares and Blackstone, and why can't I get access to anything like that? So there's huge demand from the clients, and increasingly both the wirehouses and the independents are focused on delivering that for their clients. So I think we're just responding to a large and growing market that for us is pretty obvious that's been historically untapped.
With what started, as you mentioned, non-traded BDCs and REITs, it feels like there's a growing supply of different types of structures and vehicles. Yeah. How has it evolved for you guys over the last couple of years?
5 to 10 years ago, the wealth/retail was literally non-traded REITs and BDCs. That was it. I think innovation, again, has been secondaries, real assets like infrastructure have been, I think, interesting. And a lot of folks have launched those funds. But the risk or the caution is we're not gonna blow an endless 30 product portfolio out to people because we don't want to be confusing. Our sort of view of how the market has evolved and is likely to continue is that if you're an FA, you're going to say, back to my comment of I don't want to be 60% exposed to Blackstone. I think most of the FAs we talk to will say, I want 3 to 5 managers that have a pretty well curated set of products. And again, I talked about the 3 themes that we try to communicate with them. And we played into that. We have a 6 or 7 product portfolio today to deliver to FAs. And it's credit, and it's real estate, it's private equity, it's infrastructure. And maybe we'll launch 1 or 2 more, but our focus is that's a pretty solid offering. It's pretty comprehensive. And my guess is if you're an FA, you look at Ares and you say, I'm interested in 4 of their funds, and then I'm going to do 3 Blackstone funds and 3 Blue Owl funds. And that's sort of what you deliver for your client. And you feel diversified and you're not taking single manager risk. Because again, when they're going to come back with their clients are going to be asking questions. How's performance? Or the markets are volatile. What's going on in my credit funds? You want to, I think, be able to call 1 or 2 folks that you have a relationship with, that you're invested with, right? Get a quick read on the market so you can turn back around and say, I called my folks at Ares and I called my folks at Blue Owl and this is what they told me. And then you move on with life, right?
How would you think about the space if you weren't one of the, 5 or 6 players that are capturing that market share today?
I think it's hard. And I think some of the smaller firms are trying to figure out how to access it. But again, the top kind of 3 to 5 players now are pretty consistent in terms of capital raised. If you look over the course, people's market share has changed over 5 years, which is pretty significant, but it hasn't changed that much over the last year or so. Kind of the top 5 have been the top 5 now for a while.
Yeah. As you look at each of those 3 themes, just love to hear the story behind, start with a durable income.
Ares obviously grew up as a credit firm, and a lot of what we do across everything institutional is built on private markets credit being obviously, we think less volatile, frankly, than public market credit and delivering premium yields. I mean, that message is pretty easy for people. And I think we have a long track record of delivering performance behind that message. So the funds that we have in the retail channel and credit are, not surprisingly, the largest ones that we manage and are growing the quickest. So everybody has their little niches and angles.
Yeah.
So your question is about a smaller firm. I think if you're smaller, you have to come with something that looks really differentiated, right? Because a lot of the product that they see, whether it's from Ares or Blue Owl, it's similar. And you're just choosing, I think, based on brand name or manager selection or performance, certainly. But, you get to the top 4 or 5 people pretty quickly, and it becomes kind of obvious that that's where you want to allocate.
The concept that the private credit is less volatile, it's had higher returns than public, sounds a lot like what you hear about private equity and public equity and some of the grumbling about different marks. Why would it be the case that the private credit has less volatility than public, other than infrequent marks?
It's quarterly marks. It's more mark to model versus the vagaries of the markets don't necessarily make sense. Over time, I think public credit can be hard because people tend to be bad sellers, or they just tend to be sellers because they feel that they need to, right? So, you set up buying loans at 99.5 and you get a coupon. And by the way, if you don't like the way things are going, you have the benefit of liquidity, right? But you're probably selling at 97. So if you're making a 6 or 7% coupon and you take 2 points to exit and you're in for 2 years, blah, blah, blah. It's just a sort of the nature of creating losses there. You can obviously also buy loans at par and have them trade to 102 and sell them. So if you're good, you're doing that too. But the key is really private credit. And we believe this, and I've believed it for 20 years. And this is the merit of the asset class is you've originated it. You've done tons of due diligence. You have better information. But more than anything, you kind of control your downside, right? So in most private credit deals, you're levering a company 5 to 6 times against enterprise value. Pick a maybe current number of 12 to 15 times. So you've got a lot of room. And if things don't work well, maybe you're levered 8 times. Companies still probably work 10 to 12 times. But the key is that you have the ability to actually go in, restructure and protect to the downside, maybe own a company, which we have to do, sometimes. But you have to have the resources to do that effectively. But the point is you kind of have this free call option as a lender to own companies if you have to. And if you're lending to good companies and you control your outcomes, where you're a lead investor, you can probably get to better resolutions, limit capital losses over time. And if you look at our historical charge-offs versus defaults in the public markets, they're just better over a 20-year period because of that control. But you need the resources to be able to go in and roll up your sleeves and do that.
On the theme of diversified private equity, one of the questions you always get in the structure of, say, interval funds, which seem to be gaining a lot of traction, is how does this work of an asset that is not liquid in a strategy that has some liquidity provision?
Right. So I think the key is if you're an investor in that type of strategy, you have to look for diversification. To your point, I'd be concerned looking at a fund that was, quote, semi-liquid in a concentrated pool of private equity assets, because there's no easy way to obviously create capital to the extent you can manage it by having a credit facility that you leave undrawn, and you can draw down your credit facility if you need it. And there are other ways to manage through it. But I think the key is in a private equity strategy, you want a lot of diversity, a lot of diversification.
And how do you think about that liquidity requirement as a strategy, maybe different from how you might go about, you could say, an institutional strategy or a private equity strategy that doesn't have that need for the broad diversification?
The whole big picture wealth, it's something that we talk to the wires and the FAs about a lot, which is the key is that as this market is tapped and growing, that it's actually done thoughtfully, right? And we just tell everybody that the education is the key. And we're like, it is semi-liquid. Like, you're not going to be able to get back more than 20, most likely 20% of your capital over a 1 or 2 year period. So think about that when you allocate your initial check size, because it gets invested immediately, right? So as long as the end investor understands that it truly is semi-liquid, i.e. they can't get it all back yesterday, everybody still has their bird fingertips from '09 around gating of hedge funds and how it was horrible and they couldn't get their money out and whatever. But the way these structures are set up are actually set up to protect investors, because the alternative is a fire sale of assets at bad prices, which creates bad outcomes for the investor. So long as they're knowledgeable and thoughtful about what they're getting into, and that requires a lot of education, both from us and from the financial advisor community, I think this will be sensible growth, tapping a market that has a lot of desire to be in these assets.
As you look at the market for some of these products, and maybe particularly, say, interval funds, how have the fee load evolved as these products have gotten rolled out, kind of relative to what you might see in the institutional market?
What's nice here is that the fees are almost off the shelf. So if you were to launch a non-traded BDC today, you'd say, who are the biggest non-traded BDCs? What are their fees? Boom, by the way, they're all exactly the same. And they haven't moved much. We'll see if that's true of the other asset classes as well. So everybody's sort of a carbon copy of one another. By the way, the fees that are then paid through to distribution, so if you're going through a wire, are also standard. It's kind of off the shelf, and there hasn't been a lot of discussion about it. We'll see. Obviously, as the institutional market evolves and you get bigger and more folks have more capital with you, they always negotiate fee. We'll see if that happens in time, but it's not part of the discussion today. Everything is like right off the shelf.
What are some of the challenges that you've learned in managing these products in the channel that you might not have known when you jumped into it?
It's just it's very resource intensive. I mean, it requires a lot of people and a lot of education and going to a lot of conferences. And for us, it's building the Ares brand. We're still at a point that when you go to certain places, people are like, they just have a better feel for a firm like Blackstone or KKR, who's been around 20 years and is always on the front page of the Wall Street Journal. Ares historically, because we don't have a large cap private equity business, didn't have that history of being on the front page of the Wall Street Journal for, a while. Some of that by design for a long period of time before we went public. But look, after we went public, part of that exercise was, and it continues to be, building the brand, getting it out there and having people understand what the firm is, how we're different from other alternatives managers that they can obviously select with. So not that the institutional marketing business isn't people intensive, it is, but this is particularly people intensive. And you really need to be in geography, right? So like our institutional sales force is all over. I mean, we have folks in California and the Northeast and the Southeast, and obviously in Asia and Europe and whatever. We need somebody pretty close because they actually have to go into a local market like that and see the FAs there. And these are FAs that manage $500 million to $1 billion of client money. And if you want to try to get that deep with those type of folks, which over time I think everybody needs to, it just requires a lot of people.
Yeah. How have you figured out how to maintain a consistent brand message when you have so many different people going out telling the story?
I mean, it's just making sure at the top of, AWMS, Ares Wealth Management Solutions, there's kind of a consistent view of what we stand for, what differentiates us both in terms of people and performance. And then these three themes that I mentioned before were kind of the things that we lead with. And we're like, these are the themes that we want to be consistent on. And then we put the product that we have behind those themes, and it all hangs together pretty well.
When you have what feels like a tidal wave of capital coming, and you're one of the players in this mix, how do you think about the level of excitement and what energy you have to put in to make sure you capture an opportunity like that?
I mean, I think we've done it. We've spent a tremendous amount of energy at the most senior levels of the firm. I mean, Mike, myself, a whole bunch of others, spend a lot of time on this. The big dollars as you go in inevitably are driven by the wires, right? Because they're the largest, AUM, so Morgan Stanley, Merrill Lynch. I mean, these are huge drivers of capital. So early days, we went and had very senior level meetings at those platforms where obviously we have great relationships because of what we're doing elsewhere, not in the wealth channel, and said, this is something we're really focused on. And we want to be top 3 with you guys. And these are the products that we want to have on your system. And there's huge, in a place like Morgan Stanley, there's huge manager vetting and selection teams. So, we were doing that years ago, and we weren't doing it with like salespeople. We were doing it with like the senior most people at our firm to make sure that they actually understood what our vision was. So I think we're pretty close to kind of fully formed in terms of where we want to be. And now it's just taking that message and broadly distributing it into smaller ticket, smaller city, smaller institutions.
As you've looked at mapping that part of it out, say the independent landscape, how do you triage what's just a huge, very...
So we do have partnerships with people, right? So there are folks out there who do that for a living, whether it's iCapital or Case. They do a really nice way of really being deep with that community that we couldn't possibly go make one-off calls on all the time. And it tends to be in group formats. And, if you're not doing it through the wires, there are folks that are able to get non-wirehouse FAs and RIAs in a room. And if I can get invited into, we were talking about Monday, if I can get invited into that room, that's a great format because you have 100 smaller market FAs all in the room hearing about Ares, hearing about how we're differentiated. And they're like, oh, great. Now I'm going to see this on offer. I have a better feel for who they are and what they do and how they're different. But it requires a lot of running around and just trying to get in front of people because those tickets are small, right? I mean, if you're talking about a $1 billion RIA in a smaller market, they probably have, maybe it's $110 million clients, 200, $5 million clients, and their allocation is going to be 300,000 to 4 funds, right? Like that's hard for us to chase down if we're not doing it in some sort of group format. And if we put on our own things, right? So we do events where we get those people in a room and we, do the whole song and dance and try to tell them about Ares. So we do it ourselves, but we also have partners that help us do it.
So you mentioned a surprising interest last year from Europe, and maybe this year is going to be the year of Asia. What are you seeing in the international markets for wealth?
Growth. And it's interesting because we, for a really long time, because of the public BDC, I personally, and Mike and others, spent a lot of time in London trying to figure out how to basically get some listed income fund in Europe. And we talked to every bank and everybody. And there were a couple examples of things that got done pre the GFC that actually didn't go so well. We kind of found that there were like burnt fingers on these traded or non-traded income products. And we kind of gave up and just said, we'll raise institutional capital here. And I don't think this is going to work. Launching some of these income products in Europe was actually pretty eye-opening for us because we attracted a lot more capital, as I mentioned earlier, than we expected. So that's a good sign. We think Asia, part of it is just we're new there with people on the ground, right? So we have the first year effect. I think my comment on Asia is more about our first year effect this year than anything else. But look, it's a big market with a lot of the same dynamics that exist here, which is you just have folks that increasingly are hearing about all this stuff that these alternative managers are doing. And they're saying, why don't I have any exposure to this? And if we're smart, and others are smart, which I think we've been in developing the right products and just simply making them available and making phone calls to make them available, there's demand there.
As this gets more and more popular and that say 40 billion becomes whatever it does, whether it's 20 or 40% of your growth. How do you think about the implication of that sort of large flows coming in on the markets that you're investing in?
The influence is when you see large flows, that money has to get to work immediately, particularly in the income strategies. So we always we're used to it with the public BDC, but it's inherently procyclical money, right? So you're taking inflows in during good markets. By the way, inflows tend to go down in bad markets. Unfortunately, you wish you could convince retail to sort of like come in during bad markets, but usually it doesn't work that way. So it does have a bit of an influence, and particularly with a couple of our competitors that are more oriented to retail than we are. If they have a big flow quarter in a particular product, we'll see them be very competitive on new underwritings because they have a bunch of cash sitting around that they need to deploy. So it kind of comes and goes point in time. Actually, somebody asked me a very good question that no one had asked me before, which said, will there inherently be worse performance in these funds because the money is coming in a procyclical way? I said to him the same thing, which is convince your clients basically to not redeem during volatile times. And if it's really volatile, you should probably convince them to try to allocate a little more. But timing vintage is tricky for anybody. And, it's really tricky for a mass affluent investor. But it's a good question. We'll see. But because it's procyclical money, it inherently has a little bit of an impact on the investing environment, kind of on a quarter-to-quarter basis. Over time, it should smooth out.
How do you think about the maintaining discipline in underwriting standards when you're faced with capital's in and you have to put it to work?
It's really only relevant, to be honest, in our credit products. We want a balanced set of capital sources. So in credit, specifically to private credit, because it's most relevant to the wealth piece where everyone has BDCs. We have commingled funds that are drawdown funds that obviously are not remotely procyclical. You can just say we're not deploying anything in that fund. We have separate accounts, same thing. We have a public BDC, which depending on repayments is either needing to put capital to work or not. And then we have retail credit funds, right? So as long as we have kind of a balanced roster of stuff to deploy, we're not under so much pressure to deploy because of the balance of capital that I feel comfortable with how we're set up. I would not want 75% of my credit capital to be in a procyclical structure like this, which it inherently is. And that's where you can lose discipline.
As you look at planning your business for what you think is going to happen, what do you see as risks or scenarios where this doesn't play out?
Growth that's too fast, with not enough education. It's just not good for the growth of this industry. It just needs to be smart growth where people understand and are excited, hopefully, right, about what they're getting access to. But you just don't want to grow too fast, which is why we've tried to create the infrastructure with the 150 or so people globally that we can get out there. But the question for me when we launched, the credit funds in particular was, how do we shut it off? We've seen one or two competitors in the BDCs and retail, they call it queuing. It's not, so you queue new and you basically say, we're not really accepting new capital right now. The FAs tend to not like that because they have clients who want to put money to work and you're basically turning them down. We've actually seen one or two of our competitors queue credit capital over the last year or two. And folks have asked me what I think about it. And I said, I think it's really smart. Like if the investment environment's not there, you shouldn't be taking procyclical capital and putting it to work at any price. So the risk is that it grows too fast and that people underwrite poorly because of the nature of the capital, and then the returns aren't there and you lose confidence and all of that.
Eventually, we probably go through another cycle. Maybe there's a recession at some point in time. We'll see. How have you prepared for both the sort of education and client management, and then in your portfolios when there's been such a wave of growth in the space for a time that isn't as robust?
It's inherently not any different than the institutional market, right? Because you're always talking with clients about times seem good, but what happens if they're not? And we talk about our track record of managing through cycles and downturns and our risk management infrastructure and portfolio management chops and all that stuff. So I don't think it's different, but the retail investor kind of hasn't been tested yet, right? Because most of this has come online kind of with COVID and coming out of COVID. And it's been a pretty easy kind of, low vol period of time. So I don't think it's any different, but I'm not sure exactly how it'll play out with this customer base. And again, I'm just hopeful that there is enough education and enough understanding of the structures, which I do think are set up well to protect investors in downturns. And then we'll just do what we always do, which is we'll manage the capital the same way in these funds.
All right, Kipp, I want to make sure I get a chance to ask you a couple of closing questions that are different from the last time you came. What was your first paid job?
I was a golf caddy. I think that was my first paid job. I think it was like 13, 14, something like that.
And what'd you learn from doing it?
To be honest, I grew up in a place where we had a lot of doctors and lawyers and bankers and that kind of stuff. So I was lucky. I kind of learned how to talk to some of these, old rich guys who like to play golf. And I was pretty well behaved, to be honest. It was, be buttoned up and make conversation, but, do what you're told. And, if you did that, you tended to get paid a little bit better. So
how's your life turned out differently from how you thought it would?
I feel very blessed and very fortunate. I mean, I don't know if it's different. I feel like I've achieved a lot of the things that, frankly, I had hoped to achieve through hard work and partnership with friends that I've worked with a long time now. And, I've got a great wife and great kids. And, I just feel very blessed. I don't know if it's different, but I feel like the things that I was hoping would come around came around.
What's a mystery that you wonder about?
I don't know. I think a little bit about, just as we're all getting older, about mortality and sort of what happens and where you go and what's the truth there is something that's always been a mystery for me, but we'll see if we ever figure that one out.
All right, Kipp, last one. If the next 5 years are a chapter in your life, what's that chapter about?
I've got 2 kids in high school. And, one is going off to college next year. The other one's a freshman in high school. So she'll be gone in 3 years. So if the next 3 years are obvious for me, which is I've still got kids who are in the house and going to college and all that. And I think when we get in years 4 and 5, the question will be, what are we doing? I'm still very engaged and enthusiastic about my job. So I'm trying to make sure I enjoy that 5 years of still having the kids around, still having a job that I love, working with people that I love. I think the harder chapter for me is what's the 5 to 10 years, and it's whether I'll still be enthusiastic and super engaged, or whether the kids will be gone and I'll want to go, follow hobbies, passions, travel, skiing, whatever else. So, but I think the next 5 years, so long as everything hangs in, I'm kind of doing what I'm doing for the time being. And I'm pretty enthusiastic about it and frankly, pretty lucky to have what I have. So
how about the next 5 years at Ares?
I think the platform is kind of, for the time being, fully built. We feel like we're in all the asset classes on the alternative side that we need to be of the most value to clients, whether it's institutional or retail. We're focused on making, frankly, some of them a little bit bigger and better, particularly probably in real assets and private equity, and then a focus on growth in Asia. I don't think, having done a handful of acquisitions to kind of fill out our dance card over the last couple of years, there's anything really big that we're missing or that we have our sights on. Never say never. So I think it'll be more of the same. Keep up good performance, keep attracting capital, make sure we retain the people that we have who we think are great, and kind of continue pressing a lot of the advantages that we've built.
Well, Kipp, thanks so much for sharing this great insights.
Always a pleasure.